Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And look who's in the office today. Not on one of his due diligence assignments, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Just trying to keep it going around here. Been pretty darn busy, to be honest with you. So glad to carve out a little bit of time to do a podcast today.
Yeah, you guys over at SPI have been very busy. Man, you're in the middle of two transactions, right? You sold two, you're buying two, man.
Refinance like 6, I think. So we've been super busy. Got about 2 more to refi. So just been chopping a lot of wood and made a lot of progress. So almost out of problems, Paul.
Well, almost out of problems.
Yeah. What's new in the Old Capital world? What's coming up?
So as you know, we do our Old Capital speaker series. We try to do it once a month or once every other month when we think there's a topic that I think people would enjoy. Coming up here on April 26th between 6 and 9 p.m., it's going to be the Old Capital Speaker Series featuring property management and asset management. So we're going to bring in 3 different property managers that kind of take a look at A, B, and C different types of properties, and they give us their opinion about what's going on. It's going to be an interactive discussion, a great networking opportunity for people who are thinking about getting into the apartment business or in the apartment business as limited partners, that they want to kind of figure out how to bring operational efficiency to ownership of multifamily properties. So we're going to have some great property management companies that we've kind of chosen that we've heard before, but it's going to be an interactive discussion. So your eyes are not going to glaze over after listening to property management for about 5 minutes. And so we're looking forward to having you come out. Just make sure you go to the oldcapitalpodcast.com, Old Capital Podcast, and RSVP for, again, Wednesday, April 26th between 6 and 9 p.m. in the suburb of Dallas in Grapevine, Texas, at the Grapevine Convention Center. Make sure you RSVP to that. So in the podcast today, we have some of our friends that we've known for a long period of time that we think are just great experts in multifamily sales. They've been delivering satisfaction to buyers and sponsors and limited partners for a long period of time. So our friends over at Newmark have joined us in the podcast. I'd like to just go around the table. Jacob Anderson, how are you?
Good. Thank you, Paul, for having me.
No problem. Bart Wickard, how are you?
Hey, guys. Doing great.
Good. And then also following up, like always, Matt Weidman. Matt, how are you?
Howdy. Doing great over here. Thanks, Paul.
Bart and Matt kind of work in the secondary markets for Newmark up in the Dallas-Fort Worth office. These guys do billions and billions of dollars worth of transactions. On a good year today, and maybe not so much of a good year, and we'll talk a little bit about that. Jacob Anderson, who kind of focuses on the central business areas of Dallas, Fort Worth, kind of the metropolitan areas of Dallas and Fort Worth, and everything around it, whether it's Denton or it's down in DeSoto or any place in between. He is the guy with his partners that really looks at the A-class properties, the B-class properties, and he sometimes looks at some C-class properties that he brings in and offers those for sale on behalf of his clients. And so that's what we're going to talk a little bit about today with Michael, is just kind of the state of the market. So, my question today for the guys, and Michael can take it from there. If interest rates go down, will volume go back up? So let's talk a little bit about that, and then I'll kick it over to Michael. So Michael, why don't you go ahead?
Yeah, I think that's just generally kind of what are you guys seeing? I mean, maybe we can kind of bounce back and forth a little bit with talking both kind of in the Dallas-Fort Worth market, which probably representative of a lot of the major metros across the Sun Belt, and then kind of the secondary market. So, what are you kind of seeing today, Jacob? I know you guys are all coming out of NMHC, or we all did, and as we were kind of started, Bart was talking about how excited he was. So what's kind of transpired, and kind of what's your general take on the market right now?
Yeah. So taking us back and give a little bit of what we've seen here, the last 2 quarters of 22, they got slower and slower and slower. So going into an NMHC, new year, 2023 starting, you could start to feel people, they wanted to do stuff again. NMHC, which is our big national multi-housing conference, which was in Vegas this year, was bigger than ever. A lot of energy. Sounded like a lot of people wanted to get into the market, not sure when, but things were starting to come back. We have seen that being followed up here in the first quarter. We have had a couple of deals in the market, and we have seen a generally solid group of people showing up looking at these deals.
What's kind of like the deal volume? So I know it seems to me from my perspective that you're probably, I don't know, maybe 25% of normal deal volume of normal listings right now compared to, so you're probably off 75%. Is that somewhere in the ballpark of what you guys kind of feel right now?
You're very kind, Michael. I think 25% is probably aiming high these days. I can give you a reference of NMHC is typically where we take a lot of our listings out, new listings coming, and we will have anywhere from around 20, 25 listings. This year, we had a small handful of deals. It's not that we are just sitting on our hands and not doing anything. We're underwriting a ton of deals. But when the interest rates are going up that rapidly and the pricing is going down, you have to pick and make sure that you do your clients right with taking the deals that will make or have a good potential to make to market, and that you season the deals that needs more time and wait with it. And the result is probably below 25%, probably closer to 20% of normal listings.
And so with a limited inventory, you're seeing just tremendous amount of CAs and tours and buyer interest per listing just because there's such a scarcity of listings. Is that an accurate way of portraying what's happening right now?
I would say we see a reasonable amount. It's not like when we look back before COVID, at that time, it was almost too much. But we're still sitting in a market here in Texas, in DFW in general. It's good markets. And there are parts of the country where you're dealing with rent restrictions and a system where it might be slightly harder to evict people that's not paying rents. We're a little bit more progressive here. And I think the investors and around the nation, they see that and they're coming here to either buy more or they wanted to enter and now they're coming here. So there are some obstacles in the market that's not bringing a new record level of CAs signed on these deals. But in comparison to the end of last year, it's very healthy.
And as far as the types of deals that are selling, or is there, compared to historical norms, are there more kind of Class A or more Class C, or is it kind of similar to what we've seen in the past?
Yeah, that's a really good question. And we're still trying to figure that out, what is actually selling. The data points, just due to the volume, is less. But one thing I will point out is when you see the cap rates coming up, and here I'm talking about probably in the high fours for Class A, the low to mid fives for Class B, and Class C, depending on the mechanicals and locations or whatnot, it's probably a 6+ cap in today's market. So, to sell some of these deals, I would say like the Class Cs, they're probably taking the hardest hit right now. Everyone, when there's a little more power on the buying side, everyone moves up and they want the Bs and the As.
And so Bart or Matt, as we kind of compare and contrast what Jacob just said, how is that impacting your secondary markets? And is there a bifurcation in the secondary markets from kind of the more top tier ones, like I think in Texas, of like, say, like a Tyler as kind of more of a pedigreed secondary market versus maybe some of the others across there? What are you seeing as far as, I would imagine, a higher cap rate or discounted price to, say, DFW? What are you kind of seeing right now?
Yeah, Michael, it's funny you mentioned Tyler. We have 2 properties on the market there right now, a deal called Royal Crest and a deal called Cedar Trail. So, we're getting some real-time data feedback. And as Jacob mentioned, because the number of properties on the market has declined, the attention to the assets that are on the market is substantially up. And as Jacob mentioned too, there's a line that you walk as a broker wanting to be out in the market with deals having a reason to call buyers, having a reason to call sellers. But more than ever, we're trying to take that broker hat off and put on the advisor hat. It doesn't do anybody any good, the seller or a potential buyer, to take a property to market that's just not ready. And you only got really one first time to make a good first impression. And so, we're underwriting the sellers as much as we are the deal these days. So, you mentioned Tyler, we're calling for offers this week on property called Cedar Trail. And, in place where this guy is a seller is, on an 80s vintage value add deals, a high 5 cap, which should provide positive leverage going in day one. I think a similar deal in, let's say, Plano or maybe mid cities might trend to a mid to low 5, probably. So, that cap rate differential that you typically see between Plano, Texas and a Tyler, Texas is, give or take 50 basis points. That differential still exists.
And what would that cap rate have been, 18 months ago? If it was a high 5, it would have been low to mid 4s?
Yeah, it would have been.
Low to mid 4s. I mean, I think we even did some deals sub 4. But, again, a buyer could still go in positively levered if they were borrowing on bridge debt at 3. So the answer is yes. I mean, the cap rate expansion has happened, all across Texas and the Sun Belt and the nation. And it's just a function. It's just math. That's a term I use all the time, is it's math. It's the ability for somebody to make sure that they're going in, they're covering their debt service where it needs to be, and, getting, at par or maybe even some positive leverage going in.
So who are buyers these days? I mean, we talk a little bit about who the sellers are. I mean, who are buyers? I mean, and let's break it down, because Bart and Matt, they do the secondary market. So just like Tyler is probably about 100 some miles outside of Dallas going east, they do properties in Abilene, they do properties in Midland, Odessa, they do properties out in Lubbock. And these are outside the general areas that a lot of the institutional buyers will buy in. So let's ask Jacob. Jacob, are the institution buyers back yet? Are they accumulating money to buy stuff in the future? Give me what your impression is right now.
Yeah. So from reading the newspaper, I know that they are accumulating money. They are raising a ton of it. Them showing up on a consistent basis, I wouldn't put it that way. We are seeing some institutional money coming in, and we have done some institutional grade deals that are close to the 100 million range here. That's about to close. So it's there. It's just more sporadic. The one group we are seeing coming in is, again, people that may not have bought here before, but have circled the market. They understand what they were up against when everything was good. They still like the dynamic in Texas, and they're coming here. And I would almost say fleeing the coastal areas.
Sure. Let's kind of go with that same train of thought again. Institutions are buying, I guess, a little bit sporadically, if they're buying at all. Most of them are just pencils down. So if you have a property, is it a syndication that's buying it? Are they selling? Is it an exchange, like a 1031 sale that they're looking to buy something else? Tell me a little bit, just give me a profile of who's buying properties these days.
Absolutely. So 1031, they're still in play. Now, when you have less sales in Q3, Q4, and Q1 of this year, they're just less 1031s. They're still around. And that is something like when people are listing with us, we try to the best of our abilities to get them home with the 1031. So that is definitely still an active buyer. It's also private money, high net worth individuals, some syndication money. The capital stack has switched a little bit. We're seeing some pref equity going in on deals on top of like lower leverage loans. And we also see still some equity groups pairing up with sponsors to do new deals. The big guys of the world, like the Blackstones and Starwoods, it's not like they're in every best and final. I think they're ultimately net sellers right now of some of the funds they've been sitting on, but it's still a healthy mix.
That's great. Then Matt or Bart, can you give me kind of an idea in the secondary market? We've heard from Jacob a little bit about who's buying there. Who's buying in the secondary market? Is the syndicators? Is it, give me kind of a taste of maybe your last one or two deals without naming names or areas, but give me kind of the profile in the capital stack and how it was done.
Sure. Yeah, I think there's a good mix, I would say, of buyers, and it depends on the price point of going into a lot of these markets. I would say there are a lot of buyers in the secondary markets that they're already in the market, and so they're willing to look to expand within the market. So some of those are syndication profiles. We are working with some 1031 exchanges where they've sold some deals and they're looking to find some places to place capital, and so we're working with them on some of these secondary markets that they're familiar with as well. And there is a good group of institutional type money. I wouldn't say it's the high-end institutional. It's more of like the mid-tier institutional type groups that are coastal, and they just say, hey, look, we're not going into California. We think it's a better risk-adjusted return to take a higher cap rate in one of these secondary markets. The issue that we face in the secondary markets is just like the primary markets, is just the volatility in interest rates. When you have such volatility of movement, it's really hard for a guy to make a business plan and put it together and size a loan. And you know, he says, oh, I've allowed for 25 to 50 basis points of movement in my rate, and it ends up being a whole 75 basis points or 100 basis points. And then he's kind of left there holding the bag and trying to figure out the difference. So that's the struggles that we face. And we've also dealt with some sellers that look at the world through the lens, especially in the secondary markets, so there's maybe not as many guys that are active on the buy side as much as they are on the sell side. So they're still looking through the lens of 2021 and 2022, thinking that that's where pricing is, and that they got some LOIs back then, and they need to hit that same number to achieve their return threshold. And ultimately, that, you know, I've heard it said that frustration can be defined as the gap between expectation and reality. And sometimes we live in the land of frustration, trying to solve those two, the variables in between those two, and we're doing our best to merge that gap.
Absolutely, you're just kind of a reflection of where the market is right now.
That's right.
Yeah. So, Michael, when we're talking about, Matt brought up, price point and people raising money into some of these deals. I mean, are a lot of the buyers maybe looking at smaller deals than the larger deals these days, with having sometimes challenges about raising capital in some of these syndications? Are you starting to see them come back? Instead of buying the $30 or $35 million deal, they're buying the $15 or $20 million deal. Michael, are you hearing that? Bart, Jacob, or Matt, any feedback? Are they buying smaller deals?
Well, from my perspective, I mean, I'm looking at we're doing 2 1031s right now. We had to pass a hat for a few bucks for each of them, about $7 million each, which that's a lot of money in the real world, but relative to some recent raises, it's not a whole lot. And the first one went super quick, and we had a long wait list, and then we're about to start the second one, and I think it'll probably be the same. So I don't have as much competition. Kind of that this is one data point, and it wasn't a very wide raise I needed to go, and we just sold a bunch of deals and returned a bunch of capital. So kind of had a stocked pond to go fishing in here. So I might deplete the pond here real quick. It'd be a different story if I try to go super deep. So my perspective is, last big syndication we did, we bought about an $84 million deal last year, and had to raise $33 million, and it was right in September when I think we had 2 75 basis point hikes right in the middle of my equity raise. The stock market dumped to 12%, so it wasn't exactly the best time from a sentiment standpoint in September, October last year to do it. So trying to be cautious, trying to find a deal. We're looking at one of the deals that Jacob has out, and it's kind of that $40 to $42 million range. So call that half of what we normally would do. And to Matt's point, you get into escrow on something, and you buffer at 25 bips. I mean, you usually think that's pretty safe, but hell, that could be 2 days in this market or 1 day in this market. It could go up or down, or it could go up for 3 weeks and then crash the next 3 weeks. It's really hard to do it. So I think having that smaller check gives everyone a little bit more confidence. So I would imagine, and maybe you guys could do it, I would speculate that your smaller check sizes are actually probably getting even more attention than historically where bigger is better. Is that what you're kind of seeing, guys?
Yeah, I think in general, the equity raises are a little more challenging than they were. I mean, the money was flowing like wine in 2021, 2022. Everybody and their brothers investing in multifamily, and for good reason. They've made a lot of money, right? And when you're making money and things are going well, you want to continue to invest in it. We are hearing that it's a little tougher to raise equity now than it was before. I don't know that necessarily it changes the profile of the type of deal that somebody's looking at in terms of deal size. I think it probably has more of an impact on just making sure that it's the right deal if they're going to take it on. Not sacrificing size of the deal, but maybe just feeling more confident that this deal definitely makes sense. I can make investors money. They're going to realize that. I come from a background of being a stockbroker for 10 years, and I kind of liken this environment to, the stock market in the sense that, hey, look, long-term fundamentals are great, right? And you've been making a lot of money. I mean, now is a great time to dollar cost average down. If property values are off 10, 15, 20%, it's a great time to be investing your money in multifamily. And, so I think overall, we're going to see that equity return. I mean, if you look at the quote unquote smart guys, the big institutions, I mean, they have a ton of money, like Jacob said, sitting on the sidelines or raised to be investing. And when they do, they're going to do it in a big way. And we're starting to see some of that. And I think those retail investors will follow suit. I mean, to your point, Becker, I mean, you've got the stock market going down 12%, in a week's time or 2 weeks' time or whatever it is. Real estate values fluctuate, but that's just a paper value, right? And people still need a place to live and they're going to pay their rent. And it's still a fantastic place to invest dollars. And I think the market realizes that.
Are you guys starting to? I mean, there's the gossip in our space, and Paul and I recorded a podcast about it a couple of weeks back. Is there was a giant foreclosure in Houston, a portfolio of over 2,000 units, and everyone in the space is basically gossiping about it, and kind of hearing rumblings behind the scenes. That guy bought a portfolio. He was like an IT guy 5 minutes before he bought 6,000 units and raised a bunch of money and had a high levered debt fund and pref equity behind it and 10% common that got wiped. And of course, it was obvious that was a terrible structure set up for anyone that's been around the block for a few years. It just didn't make any sense. And he wasn't alone. There's a lot of guys like that out there. And I'm kind of hearing rumblings behind the scene that so-and-so is the next one up to go that had a similar structure. Are you guys seeing any of that or hearing kind of whispers? What's your kind of expectations of, are we going to see REO and stuff like we kind of dealt with in, 9 and 10 with sales? Or is there so much money that it's going to just flood it and stop that from happening on any large scale?
Yeah, that's a good question. Talking about the future and what's going to happen. I'll say, from the conversation we have had and with the various sponsors, asset managers, whatnot, I would say most people, they're really trying the best they can. And some of it has not been dealt the best hand when it comes to the capital stack, but they fight through it and they find ways to optimize here and there and get the best out of it. So I do think that most deals are not going to end that way. There will be, I'm sure, some more to come. When and where, that's hard to say. I think for those assets, there are a lot of funds sitting on the sideline waiting for it. So if you're sitting and thinking in a buyer situation, hey, we're going to wait for the perfect hand, you'll never get the perfect hand in this game. Someone else will be there 5 minutes before when it's less perfect. So fundamentals feels good. So it doesn't feel that we are going to go to that degree yet. But again, there's some softness, and there are people that probably shouldn't sell or don't really want to sell, but they have to move money around to other deals, and there are capital calls out there. There's different strategies to go about that. Some people are afraid of doing it, and some people are thinking that we should do it upfront before the market is saturated. So I think most people are doing what seems to be the right thing, but time will tell.
Mike, is there a demarcation line or a bifurcation idea? Is it 2018, 2019? Those deals are fairly safe, and anything after COVID, those could be challenging. I mean, what's your general perspective about?
Jacob and I were talking about that. I mean, so Jacob, the deals that are selling and trading is kind of pre-COVID, post-COVID, right? So the deals that were done pre-COVID for the most part are maybe kind of the first deals right after COVID and early kind of mid 2020. Those deals have equity in them and profit, where the seller can sell and hit some level of return that maybe is not what it would have been 18 months ago, but it's still a pretty good return. And people that bought deals in kind of 21 and 22, late 21 into 22, those deals are, at par or most likely underwater, right? And so they're just, unless they're forced to sell, they're not selling. Is that kind of what you're seeing out there in the marketplace?
That's correct. If you have gone in and the market has been very, very good here and probably almost too good, especially after COVID, where we saw extremely high lease trade outs and rent growth. Deals were selling accordingly, so the prices went up. There's just not been enough time for current deal sponsors to go in and continue that trend and create the cash flow that goes now with not 85% leverage, but probably more 60 or 65% leverage on deals and at a higher interest rate. So that's the gap that needs to be reached. I think the deals that were trading in 18, 19, they have had more time, and there's a better chance of that outcome actually working for everyone, seller as well as buyer.
And a lot of it comes down to, too, just the type of debt that one used to purchase the asset, right? If they bought a deal in 2021 and put 10-year agency debt on it, and which are typically lower leverage than, an 85% bridge loan, then that person's probably sleeping at night, right? Even though their value on paper may be underwater, they're fine, because rents haven't pulled back, occupancies haven't pulled back to have a material impact on operations. But if you bought a deal on bridge debt, you probably paid a pretty penny for that. You probably are over levered. Your interest rate's double what it was before, and you got a rate cap expiring. I mean, so I think more now than ever, there's probably a recognition that piece of the capital stack, which is your biggest, is the most important.
Yeah, I think Bart brings up a fantastic point, is that not all deals that were originated and closed and done after COVID or during COVID are the ones that are going to fail. This is going to be a select few transactions that are going to have some problems. And I think Jacob talked a little bit about that the people are still trying to solve their problems, and hopefully that they have a little bit more continuous time left in the term of their loan. So, Michael, any final thoughts?
Yeah, no, I think that's right. Right, it's going to start in Houston, so your colleagues down the Houston office probably be busier, and then it'll travel north a little bit, and I think it will go to the lesser located assets and Dallas and Austin, San Antonio to be kind of Texas or regional specific, or probably even the secondary market specific. But I think probably I guess one point on the secondary markets. I mean, have you guys this last cycle we saw a bajillion apartments be built in the four majors in Texas, but was that the case also in the secondary markets relative to kind of the existing stock? Did you see a lot of supply being delivered the last 5-6 years, or the fundamentals a little bit better shape from that standpoint?
It's actually really interesting, Michael. If you look at the stock profile in a lot of these markets, there was a ton of products built in the late 70s, early 80s. It dipped in the 90s. There wasn't a whole lot. And then there were some in the early 2000s, and then literally nothing from 2015 on in a lot of these markets. And that's really bode well for the value add story in a market like Tyler or Longview or Waco, for that matter, Temple. Now, a lot of these markets just did not have the same supply. I would say Midland, Odessa is a unique market, and we had quite a bit of stock that got built out there when oil was well over $100 a barrel, and rig count was extremely high, and rents were equivalent to uptown rents on new construction in Midland, Odessa. That market has the construction pipeline has shut off. There's no new product being supplied there, and all those deals have been through lease up now and stabilized. So that market going forward should be a pretty strong market. But the reality is a lot of these secondary markets did not have the supply threshold that you saw in the major metros, which again, I think can help tell the story on a better risk adjusted return in these markets. Incomes are still good. Job growth is still good. Population centers are still strong, and people want a nice place to live. And so if you can provide that and maybe provide a nicer unit on the inside than what's existing in the marketplace, people are willing to pay for that. And we're seeing that in these markets.
And Bart and Matt, just between us girls here, where's the best secondary market to buy in these days? Maybe the highest cap rate, the most economic viability, the most inventory available to buy. What do you guys like? Again, just between us girls.
Between us girls and everybody listening? Yeah, I mean, that's a really hard question to answer. That's like asking what submarket in DFW is the submarket to invest in that's going to do the best. I mean, I'll tell you personally, I think there's a ton of opportunity in the market we just discussed in Midland and Odessa. Like Matt said, there was a lot of stock built. COVID hit that market extremely hard because nobody was traveling and oil prices went negative one day. And so you saw some challenges in the market, but they led the nation in rent growth last year, almost 20%, and it's projected to lead the nation again this year. The A-class space is stabilized, so that market should remain extremely tight for the foreseeable future. I think the fear or the expectation that fossil fuels are somehow going to disappear overnight and everybody's going to be driving electric cars and nobody's going to need petroleum. I think people realize that's not going to happen anytime soon, at least in our lifetime. And so I think there's a ton of opportunity there. Like I mentioned, we have deals. I really like Tyler and Longview, Waco and Temple, I-35 corridor. I mean, it's really more than trying to generally say, hey, this market's better or this market's worse. Every deal could have its merits. And that's where we pride ourselves in educating buyers and making sure they understand, hey, this is why maybe this might make sense. Here are the fundamentals and, go from there. But I think generally, there's a lot of opportunities out west.
Yeah.
Our favorite market is whatever market we're in that day.
That's right. So, Bart and Matt, obviously they're specialists in the secondary markets. And that's one of the things that Newmark does is that they have specialists in these markets, because if it was just Jacob that does the central business districts of Dallas and Fort Worth, he wouldn't be an expert in stuff that's 100 miles away. So that's why they bring in Matt and Bart, with their perspective. And they've been doing this for a long period of time. They've helped a lot of people. What's the best way for people to get a hold of you in the Dallas office at Newmark? Can you just throw out maybe an email address for one of you guys or both, all you guys? Give me kind of how they get a hold of you guys.
Sure. We're all kind of the same. Bart, BART, Wickard, WICKARD at NMRK, Nancy Mark Rick Kite.com or 214-420-3116.
Fantastic.
Just our first.
Yeah, I'm at JAKOB. Anderson, ANDERSEN, same handle, 214-460-6536.
And Matt Weidman, MATT.Weidman, WIDEMAN at NMRK.com. You can reach me at 214-704-8240.
Unfortunately, Matt is not a wide man, and neither the two other guys, they were actually athletes, not only in high school, but definitely in college. Matt had the privilege of meeting Pele down in Brazil when he was playing down in Brazil. Jacob and Bart swam together at SMU. So the all Americans here around the table were the Newmark team. So again, appreciate the Newmark team coming in and spending some time with us. Michael, thanks for joining us. We certainly do appreciate it.
Paul, what sports did you play at Iowa?
I was a heavy drinker,
or what?
So I played rugby and I played water polo, but nothing to the extent that these guys had done it at. So, and that's right, Dr. Becker. Thank you for joining us. All right, sounds good. We appreciate everybody listening in today. Again, I'm Paul Peebles, Michael Becker. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.